The collapse and bankruptcy of yet another private credit supported firm has generated significant unexpected losses this week. As I said last week when UBS shut down those hedge funds, it's not really about the amount of money that's being burned right now. Instead, it's what these cockroaches reveal, how they add to the growing mistrust over private credit and the entire shadow banking space. That's the real danger that could threaten to unravel a lot more than just a few troubled firms. So while you may think it's some of these smaller, unheard of firms that are getting caught up exclusively in these shadow banking and private credit messes, in this latest case, and a lot of these cases, it's actually the BlackRocks and Apollo and Oaktree. But what's more important, all these huge firms are carrying their loan exposures at 100% value, at least they were, only to turn around and admit those loans are actually worth zero. Not 100% value, 100% loss. That ain't good, and it ain't good for the entire credit market. This kind of thing is already feeding fears that what everyone says they have, they don't really have. As I talked about with the UBS matter, information asymmetry is the real issue here. It's the real killer under these strange circumstances. And that's doubly and triply so in private credit and shadow banking, where there is little, if any, information available. It's all about trust, reputational trust, and collateral, trust and collateral. But what we keep finding there's only more questions about both of those. The system was warning about this leading up to September, as I covered in a video that came out before First Brands blew up, and now we're seeing some of the consequences. And the more these 100 to 0 cases come up, the more investors are going to vote with their feet. It's the credit market equivalent of the R word, in this case, redemptions. And it goes along with the macroeconomy R word too. And keep in mind, we haven't even gotten to the flattest part of the beverage curve, which is driving all of this. And if we do get flatter beverage, we're going to really find out how much trust there is in reputation, collateral, and a whole bunch more. So our latest cockroach filed for bankruptcy actually last week. It's a national home renovation firm, so another troubled business adjacent to the growing housing bust, which stems from the worsening economy. This company, called Renovo Home Partners, it also has a financing firm that seems to be tangled up in all this. That also declared bankruptcy last week too, though it is still unclear what the exact relationships are. As I said in a recent video on one of those other cockroaches, there's too many to remember at this point, that's another thing about private credit and shadow banking, the tangled web of affiliates and related companies, real economy firms and their financing arms interacting with the debt system as a whole in various different ways that we don't really have the ability to track. All of it adds another layer, or many layers, of opacity. And as I pointed out, the past few years of Jay Powell's strong and resilient economy narrative, no one cared about these details. You didn't need to check on collateral because you never thought you'd need it. Who is borrowing and relending to whom? Don't care. Just get the deals done. Due diligence is for suckers. Volume, 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 rationalization. Suddenly you get some strain in all the details. Now they really matter. So the bankruptcy the cockroach we're talking about came about last week, but the relevant and the real newsworthy part didn't come out until now. So buckle up, here we go. About a month ago, BlackRock deemed the private debt it had extended to Renovo Home Partners, a struggling home improvement company, to be worth 100 cents on the dollar. As of last week, the firm had a new assessment: zero. The drastic revision comes as Dallas-based Renovo, a roll-up of regional kitchen and bathroom remodeling businesses created by private equity firm Audax in 2022, height of the bubbles, remember? That's a big part of all of this. It abruptly filed for bankruptcy last week, indicating it plans to completely shut down. BlackRock held the majority of Renovo's roughly $150 million of private debt, while Apollo Global Management's mid-cap financial and Oaktree Capital Management held smaller chunks, according to people with knowledge of the matter who asked not to be identified discussing a private transaction in which we would otherwise have zero knowledge to go along with these zero values. So those firms have been reaching for yield in a lot of ways while rationalizing the risk, just like everybody else has. In many ways, they can't afford not to take this risk because their own investors demand returns while at the same time demanding no risk on the higher returns. So those same investors get told, well, there isn't any risk. The Fed chair says so. And these Wall Street businesses have figured out what otherwise looks like a free money machine. But like every credit cycle built up on bad assumptions and ridiculous narratives, especially the past couple of years of the pandemic and post-pandemic, someone ends up having to pay the piper. The only questions are who gets stuck with the bill and how much it is when all is said and done. Now, the more bad deals that come to light like this, the more people who have been overlooking a lot of stuff that didn't make sense to begin with, they start to ask the uncomfortable questions that they should have been asking the entire time. And when they do, they don't like the answers they get. Suddenly they start to ask for their money back, reputation and collateral be damned. And so Renovo is proving to be yet another good example why. So let's go back to the article here. In the third quarter, these credit firms also allowed for deferred cash interest payments on its restructured debt, an arrangement known as payment in kind according to regulatory filings. Yet at the end of September, funds managed by BlackRock and MidCap Financial were still marking their new Renovo debt at par, which typically indicates investors expect to be paid back in full. At least that's what they disclose. It only took a few weeks for the situation to quickly unravel, and that's the problem. But as I said, there's also a financing firm, which is called Home Renew Buyer Inc., that's tied up in all this. And it reportedly filed for Chapter 7 bankruptcy last week too. But I haven't seen any disclosure reports on what collateral may have been offered to secure financing, who's exposed to what for why. And remember, as we go through the video here, markets told us all along that we should expect this, both in the macroeconomy and in these credit spaces, about interest rates. I've talked before about the key monetary signal. This is why. And I'm actually making a video available to you that goes into this key monetary signal, what it is, where it comes from. There's a link in the description of the video as well as in the pinned comment where you can go check out this video. We talk about the key monetary signal, what it means, and how it fits into everything, or really how everything fits into that signal that we've been getting for the last couple of years. Again, there's a link in the video description. Check it out. It's highly worth your time. The fact that this one is like the other ones, another opaque mess, generating unexpected losses, is not going to help, even if the numbers here aren't absolutely huge and gigantic. It's another case of everyone saying what they thought they had turned out to not be what they actually had. It feeds into this whole problem, information asymmetry and mistrust. The more there is of mistrust, the more the people start to question whether the numbers that they have on their statements are actually solid and legitimate. The more likely they are to say, forget everything, forget the reputation, forget the collateral you say you have, I want out. So the news that UBS was shutting down a fund with heavy exposure to First Brands was jarring, but hardly unexpected. I mean, it was a high-grade fund, which wasn't just some marketing slogan, as I talked about last Friday. These are top-tier assets, senior tranches and securitizations. Investors thought they were getting low-risk, high-return unicorns that Wall Street sells so well, and that Jay Powell indirectly blesses with his solid economy shtick. So investors found out that maybe on the hook for as much as 30% losses. So yeah, there's going to be redemptions in that fund. But it turns out there are other redemptions hitting other funds, those that are at this point directly impacted by First Brands. But it goes beyond to the very processes that Wall Street said it stuck to when putting these deals together. The trust and reputation that is being rapidly eroded, leading to potentially lots of investors' cold feet. So let's go to this other article. Questions surrounding First Brands' financial practices has also raised concerns about Wall Street's standards for due diligence. Now all of a sudden we're questioning the processes themselves. This is a clear sign of escalation. On the long list of financial firms affected by First Brands' collapse, one of the most prominent is Jefferies, First Brands' go-to investment bank for its debt arrangements since 2014. Through its investment arm, Leucadia Asset Management, something we've talked about before, Jefferies also owns Point Bonita Capital, a hedge fund that has almost a quarter of its $3 billion trade finance portfolio invested in First Brands receivables. That's a big problem. So investors, including BlackRock and Singapore's sovereign wealth fund, GIC, have asked for partial redemption of their funds in Point Bonita, and Jefferies stock has fallen around 19% since First Brands filed for bankruptcy. Other prominent financial institutions with significant lending exposure to First Brands include Switzerland's UBS Group, we talked about them, Japanese lender Norin Chicken Bank, and trading firm Mitsui. The ramifications also reached the U.S. regional bank, Western Alliance Bancorp, which lent money to Point Bonita and took on First Brands assets as collateral. And another big point here, these are top to your names. BlackRock, Apollo, Oak Tree. These are the people who are supposed to be doing their due diligence, who are supposed to say, look, we know what we're looking at, we know what we're dealing with, so you can trust our judgment on this. If they're falling for these things, if they're getting into the same trap of falling into the rationalizations, not doing their homework, what about all the rest of the system? And all of them thought they were good the entire time. So yes, there was huge fraud here with First Brands, but it's proving not to be a one-off, as Renovo is again reminding the system. So while investor redemptions in vehicles like those exposed to First Brands, that's not good, it makes sense as just a knee-jerk response. But it was the other fund that UBS announced it was shutting down last week that was an important clue about where the system is going, about whether investors really are starting to get cold feet on the entire space. This other one reportedly had no exposure to First Brands at all, which means that, yes, more than just an investor foot or two really are getting chilly. They're saying we don't care what the fund has or what it claims to have. Just give us our money back before we find out it doesn't have what the fund said it did. If BlackRock can go from 100% to zero in the blink of an eye, the chances of seeing this happen again are a lot higher than people were anticipating. And we have been warned about this the entire time. There have been signs, growing signs, especially with the macroeconomic relationships, that there were going to be higher than expected defaults and distress across the entire private credit space. I did a video on this back in September where we went through some of the details or some of the estimations that were available, suggesting there's a lot more of these cockroaches scurrying around than people were prepared to admit. Shadow banks don't have to tell the public really anything. Plus, as I said at the start, they have wide latitude and a lot of credit arrangements to modify loan terms so as to avoid having to say a loan isn't performing or, worst of all, has actually in reality become non-accrual. These are called selective defaults. And among them are modifications like something called payment in kind, or PIK. This is where a borrower might be falling behind on interest and principal payments, yet the shadow bank lender says, no big deal, just pay all the interest and principal you owe at maturity. So there's a big payment awaiting for a borrower that's already in big trouble, yet the loan carries on like nothing has changed when something big absolutely has. Like I said, there isn't a whole lot of data out there, but there are some tantalizing nuggets that we can depend upon and draw upon to start to fill out a bigger picture of what might be happening, even though we can't see it directly. And one of those came from Standard & Poor's last month, which put out a report that was simply titled Private Credit, the Rising Defaults. And we talk about private credit, we're also talking about what shadow banks are offering. And it detailed and gave us more estimates about these selective defaults and how it seemed that many of them were being used purposefully just to avoid having to make any disclosures. Quoting the report here, more than a third of borrowers from S&P Global Ratings credit estimate pool that were subject to actively tested leverage-based maintenance covenants appear to have loose thresholds with current headroom above 40%, and even higher proportions in the core and upper segments of the middle market. These large cushions reflect covenants that were set very wide to closing levels as opposed to signaling meaningful deleveraging. These generous covenants are leading to a rising trend in selective defaults, which, again, quoting S&P here, is quite concerning. And S&P goes on to note, quote, the study highlights an alarming surge in selective defaults, which outpaced conventional defaults by a 5-to-1 ratio in 2024, just 2024, driven by flexible covenants and payment-in-kind conversions. In other words, there is a lot of modification going on in what appears to be another dose of shadowy extend and pretend. And it wasn't just S&P. We've got, as I said, a couple of other sources, and I'll give you a couple examples here. Valuation firm Lincoln International, also from last month, it wrote, quote, as a result, the use of PIK, that's payment in kind interest, may be a better indicator of stress. Lincoln saw that PIK interest is present in 11% of all deals it values, 11%. And of those deals, 53% had bad PIK. An example, PIK was not elected or available at close, but is now being utilized. This translates to a shadow default rate of 6%, which may be more indicative of the health of private credit down in the shadows. This rate is further corroborated by the fact that the average loan to value for companies with bad PIK was 45% at inception compared to an average of 83% today, a very, very clear sign of stress. This current, and they're using their term here, shadow default rate of 6% compares to just 2% back in 2021. So right there you can see the forgot how to grow economy that is now being covered up by extend and pretend latitude among shadow bankers. And here's another source, one that was reported by Bloomberg also in August, late in August, which also found pretty similar shadow default rate numbers. Going to the article there, quote, warnings on defaults are starting to pile up in the 1.7 trillion private credit market. It's probably bigger than that, prompting at least some analysts to raise concern about unappreciated risk in one of Wall Street's favorite money spinners. While there is no universal definition of what constitutes default, and that's the problem in private credit, default rates for the market are currently in the 2 to 3% range, but if so-called non-accrual loans, those on which lenders expect to book losses, if they're added to the mix, that rate climbs to 5.4%, according to a JP Morgan Chase report that's based on data from KBRA DLD. Now, that video was produced and published even before First Brands came to light. So in light of everything that we know now, it takes on extra special significance, especially since we're getting more and more signs of the R word, the progression beyond just strictly credit potential and credit loss potential more toward the liquidity side of the spectrum, especially when you have these cases that involve the big guys on Wall Street that go from 100 to 0, seemingly in the blink of an eye, and everybody's saying, what the hell's going on here? Maybe we need to start really asking the uncomfortable questions that we should have been asking all along. Let's start with not just the process that go behind all the shadow credit stuff, but how the economy really is and where it's really going and how all of it relates together. Flat beverage behind everything. The main problem with these 100 to 0 losses is simply Jay Powell was utterly wrong about the resilience of the economy. He has since had to backtrack in calling the labor market solid, as the evidence has been overwhelmingly flat beverage instead. Now, this is bad news for corporate borrowers. After all, if businesses are going to be increasingly laying off their employees, they're not going to be in any shape to pay back corporate credit to shadow firms and private credit lenders. But flat beverage also means trouble for workers as consumer borrowers, who are going to struggle paying back loans under rising unemployment. And once again, we find autos as ground zero in this growing credit mess. Let's go to another article. The share of subprime borrowers at least 60 days past due on their auto loans rose to 6.65% in October, the highest in data going back to 1994, according to Fitch Ratings. These cracks in consumer health came into stark view in September when Tricolor Holdings, a used car dealer and subprime auto lender, suddenly declared bankruptcy. That's since forced a reckoning among major financial institutions that have exposure to subprime borrowers, and as we're seeing, more than just subprime and more than just auto. And this is happening at a time when there are more borrowers in the subprime category than at any point in the 2020s. Going back to the article, the share of consumers in the riskiest credit category has grown this year, reaching levels not seen since 2019, according to TransUnion. Subprime borrowers accounted for 14.4% of consumers tracked in the third quarter, up from 13.9% in the same period last year. So there is no booming economy. There hasn't been a booming economy. There is a boom in stocks, but stocks are not reality, nor is the Fed's interpretation of everything. The worse it gets in the economy and labor market, the more pressure will build on a credit system that is already seriously strained. That's why we keep getting these loss cases showing up. They are symptoms of that rising stress, both on the macroeconomy and the pressure the macroeconomy is placing on the credit system. It's not just subprime and it's not just autos. And the common theme in all of it has been what everyone said they thought they had, they didn't really have. And if we keep repeating these outcomes, redemptions won't just be a few around the edges related to these specific loss cases like the second UBS hedge fund. The redemptions are going to start applying to wider and wider circles. So it starts with maybe those slightly adjacent, then it goes to some, maybe in the same corner of the credit markets. And if it keeps going, if we keep seeing 100 to 0 cases, people are going to completely blow past reputation and collateral assurances. And then we start talking about contagion and liquidity pressures beyond everything else. So contrast this with what happened in April. April was a deflationary event that started from the outside, a broad and general fear that impacted markets and made a lot of them illiquid. While that may sound worse, This procession actually is, where it starts from the inside and erodes the foundational supports to the market so that if it does go too far and it does get to broad illiquidity, that support is gone. There's nothing left. There is no trust. Collateral means nothing. There is, at that point, no going back. The good news is we aren't there yet. In fact, we're a long way from there. The bad news is this is how you get to that point. And let's keep in mind here, the background behind everything. The markets have been telling us all along, say it with me, interest rates are going to go down. They're going to go down by a lot and stay there a long time. And everything that we just talked about and progressing beyond this point to that point of no return would be one way to get there. There was a lot more in that September video that I did that talked about how shadow banks came about, what role they're trying to fill, and information asymmetry and everything else. That's the video I've got linked below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.